Hi, I'm Brendan Mills and welcome to episode 9 of Finance Coach TV, you and your business's finance coach. So in the last 3 episodes, we've looked at the first 2 components of your balance sheet, your assets and your liabilities. Today we're going to look at the third and final component, and what I believe often is the most important component is the equity. So what is the equity of a business? Well, remember that previous episode where we used the example of a house to show what a balance sheet is. So today we're going to go equity is your assets less your liability or liabilities equals your equity. So we obviously want to have more assets than we do in liabilities so we can build that equity. So like the example we used previously about owning a house, if you have, let's say, a house that's worth $500,000 and you've got $200,000 worth of debt, then you've got $300,000 worth of equity. You're in a better position than somebody who's just bought a house, say, and the house is worth $500,000 and they've got $450,000 worth of debt on it. They haven't got as strong an equity in that property. And it's the same with business. As a business owner, and the first area I look at when I look at a business's financials is to see how much equity they have. The higher the equity, the better for the business. So let's look at what makes up the equity though. And there's a couple of anomalies that you're going to have to, I'm almost guarantee within your business, you will look at things differently to how I've got them here, but it's really important to understand, the reasons why I look at, the equity of a business the way I do. So let's go through it. So the good thing about equity is generally it comes down to 5 or so different types of items that are included, and most of them are pretty self-explanatory. The first one is your issued shares or settled sum or another type of nominal setup amount. So generally speaking, most small and medium business enterprises would either be running a company or a trust or potentially a partnership. And when those entities were formed, there was a nominal sum used as share capital if it's a company, or a settled sum if it's a trust or partnership, or partners funds in a partnership for say anywhere between $1 and $100. So that's a very nominal figure, and it's purely just to, in paper and in theory, to get the formation that your business is running under up and running. So that's the first component there. So generally speaking, it's a very minimal component of your equity, but that's the first part, and it's important to understand where that comes from. The next part is retained profits. So retained profits, again, they're only relevant if you're a company because all other forms of business structures can't retain their profits. And I'm not going to get into the legislative and tax reasons behind that, but only a company can retain its wealth. At the end of each financial year for other entities, it needs to distribute those funds. Again, that's generally just on paper and distributing those funds to its beneficiaries or to its partners or to a company, for example, for tax purposes. So if you've got retained earnings, then you're more than likely running a company and you can keep those within the business. If you're running a trust or a partnership, as you know, at the end of the year, all the profits you make, you don't just transfer that money out of a bank account and give it to the beneficiaries or partners. That's something we'll cover off in a moment, and that's why I mentioned before about when I look at equity, it's probably slightly different to how you've got it in your balance sheet at the moment. So let's continue. Current year earnings, that's another form of equity. So how much profit or loss have we made during the current year? Obviously we want it to be profit and we want it to be as great as possible, but that's the next component that makes up your equity. Generally speaking, an asset re-evaluation or revaluation within your equity is only for businesses that need to have their assets revalued from time to time, which is generally your listed companies or publicly owned companies. For your small, medium enterprises, there's no real necessity to revalue the property and then include that on the balance sheet. But if you're running a large corporation, you need to revalue those assets, every 12 months and sometimes more frequently, and include that revaluation within the equity. So that's another part there. You might not see it in your own personal business, but that's something that you may see within other businesses. the last part, and this is the part where I believe my philosophy differs from how most balance sheets appear. And I believe in your equity you should include related party obligations. So what is a related party obligation? Well, most small medium businesses, they're owned by husband and wife, solopreneurs, so solo entrepreneurs, and generally speaking, the owner is a very close-knit group of people, husband and wife or family members. So quite often though, as I mentioned at point 2, other than a company, no other entities can retain their profits at the end of the year. So what the related party obligations are is your accountant at the end of the year will, on paper, transfer that money to the beneficiaries. But the reality is the beneficiaries or the partners don't actually pull that money out of the business. They probably take it out during the year in smaller amounts, but generally speaking, they won't take out their whole profit in one lump sum. So if you include related party obligations, that's a really important part to include within your equity, because if you have you yourself are owed money by the business, but you've retained that within the business, then really I see that as retained profits. Again, if you've actually taken money out of the business but you haven't generated sufficient revenue, those related party obligations need to be included as well, because you've taken out an entitlement and you've reduced your retained profits. So when I look at it, think of these two here as very connected. Your related party obligations, they're generally the result of previous year profits or drawings that have been taken out of the business. So you've either increased your equity or you've decreased your equity as a result. So look at those as two amounts that should be seen as together. So if you've got beneficiaries, companies you distribute to, and things like that, they should be included within your equity. In the coming weeks, we'll go into this in a bit more detail, but your takeaway action for today is to look at your equity, and most importantly, look at point 5 and look for related party obligations to see if you have any within your business which you should really be including in your equity, because chances are they're currently being shown in your assets or they're being shown in your liabilities. And I think to get a fair reflection of where your business is at, include your related party loans. Hope you've enjoyed the episode, got a lot out of it, and I look forward to seeing you in the next episode.